Investors who try to time the market often get in at the top and exit at the bottom. This has caused many investors' returns to continue to fall significantly behind over time. What's worse than this are the common human psychological biases that often lead to poor decisions and investment blunders. To be a successful long-term investor, you must overcome these decision-making biases, so let's talk about a few of them. Loss aversion. One of the biggest investor biases we have to watch out for is loss aversion. Loss aversion is an emotional bias that makes us take or fail to take action to avoid a loss. It's an investor's way of avoiding the pain that comes from losses in the market. This aversion to pain stems from the fact that humans experience the pain of loss twice as intensely as the joy of an equivalent gain. A groundbreaking study published in 1995 discovered that investors felt 2.5 times as bad about a dollar loss as they did about a dollar gain, meaning that we're equally concerned about a $1 loss as we are about a $2.50 gain. For example, most investors would avoid a 10% risk and choose $800 over a 90% chance of making $1,000. We manifest loss aversion mainly in two distinct but opposite behaviors that are deeply rooted in a powerful, fear-based emotional bias based on prices rather than basic investment fundamentals. First, we tend to lock in losses after a sharp market decline to avoid further losses. For example, it's rare to see an average investor increase risk on his portfolio when the market rises by, say, 25%. But if the market falls by 25%, we tend to panic and immediately exit our position. We do this to avoid more losses, but at the same time, this type of action makes us miss any chance of getting our money back in the subsequent recovery. This is one of the most dangerous things we do as investors, and it causes our strategies to fail. Investors need to understand that resisting a knee-jerk reaction when markets are stressed is important to our failure or success in the market over time. The second behavior that reveals loss aversion is our unwillingness to accept a loss on an investment. Sometimes, as investors, we seem not to know when to cut our losses. As an example, consider an investor who purchased a stock. After the company failed to secure a significant contract, the stock dropped 25%. Now, it's important to note here that the drop in share price is primarily the result of a change in the investment rather than a market fluctuation. So instead of locking in a loss, an investor may hear a voice, typically her bias, telling her to wait for the price to return to its purchase price before selling. But if the investment failure is fundamental, this typically doesn't happen. This is generally known as the sunk cost fallacy. We're reluctant to abandon a strategy because we've already invested so heavily into it. Familiarity bias. Familiarity bias is the desire to stay within our comfort zone and overestimate the choices we already know. In general, when people are given two alternatives, they tend to gravitate toward the one they're more familiar with. People tend to be unsure or uncomfortable when trying new things. This also happens in investing. As investors, we're more likely to go for investments we know or have heard about than those we don't. In fact, the more familiar a security is, the more likely we are to buy it. We're biased toward thinking that investments we're familiar with come with lower risk, even if data shows that may not be true. Familiarity bias could explain the main reason why many young investors tend to favor blue chip stocks or stocks of household company names. For instance, a household that uses Apple products or a young investor that uses Netflix is a lot more likely to hold Apple or Netflix stock. Familiarity bias also explains why investors tend to buy shares in the companies they work for, or why many investors limit their investments to domestic or local stocks or sectors they're familiar with. The problem with confining ourselves as investors is that we may under-diversify our portfolio, which could lead to lopsided holdings. Also, it's easy to find ourselves underestimating the amount of risk in the investment since perhaps we're prevented by sentimental values. These sentiments prevent us from acknowledging available data, which presents a greater risk that inevitably causes even the best strategies to fail. Hindsight bias. It's also known as the "I knew it all along" phenomenon. Investors with a hindsight bias notice patterns in past events, interpret these patterns, and attempt to apply them to current or future market results. The issue is that our minds frequently create patterns where none exist, and in reality, market outcomes are unpredictable. Furthermore, because the investor's mind is clouded by emotion, there is a tendency to relate two market conditions that are not the same. Expecting a market to turn out the way it did in the past, based on some pattern, is not a great reason to invest. Plus, there are rarely any patterns or predictability in past events, except when we look at the market through a skewed future lens. When we become overconfident in our investment abilities or knowledge, we tend to disregard our investment strategies, which can lead us to make riskier investments without proper research. Hindsight bias causes us to be unprepared for unexpected outcomes and to fail to track our portfolios regularly. Investors who are influenced by hindsight tend to base their decisions on major events and ignore those that have little to no direct impact on their investment. Also, it makes investors rely on their memories rather than logical, systematic, and thorough analysis, which can lead to wrong investment decisions. Trend or flavor of the month bias. Perhaps the strongest investing bias that causes investor strategies to fail is this one. Trend chasing is a mentality that makes investors follow a trend or a particular stock wildly considered the flavor of the month or the best pick. This bias makes investors latch on to what feels like a new idea, a hot sector, or some super stock that makes perfect sense and is guaranteed not to fail. As a result, investors follow the crowd without considering valuations, risk factors, investment styles, psychology, and strategies, among other important factors, before buying that investment. A lot of the time, as investors, we chase these trends because we believe we see patterns and can predict the future by studying past events. But even if we find patterns, that alone is not a great basis for making investment decisions. Thorough and proper research needs to be done before investing. The truth is, we can't build and protect our wealth by chasing the flavor of the month, because markets change so quickly. Investors should not allow the buzz around these best picks to take over well-reasoned, detailed, and critical investment decisions. Chasing returns and trends is certifiably crazy because the hype around any investment does not make it the right move for every investor. Confirmation bias. Another bias we have to watch out for as investors is confirmation bias. This happens when we pay attention to or sort for information that confirms or aligns with our preconceptions rather than what the data shows. Investors often ignore any new data that contradicts their initial view or just look for reasons to dismiss it. For instance, if an investor is worried about a crash amid the huge amount of data available, she is more likely to focus on news that backs up her theory while dismissing those that don't. Similarly, if she thinks markets are set to rise, she'll most likely make excuses for negative data and just stick to her original view. To minimize our confirmation bias, we should seek information that causes us to question every investment position. We should always consider why we might be wrong. To overcome these biases, we need to manage our emotions as investors. Investors who were hurt by a past financial crisis have more fear of investment losses, and these emotions contribute to the pain of selling under certain market conditions. Also, proper asset allocation is important as it helps you diversify your portfolio by combining different asset classes. Diversification provides your portfolio with the possibility of growth and protection against loss. Most importantly, to be successful with any strategy as an investor, you need to have a systematic investment plan. With a SIP, you don't need to worry about timing the market. It helps you buy more units when the market is low and fewer units when the market is high. When you base your investments on a carefully laid out plan that reflects your asset allocations, personal goals, and risk tolerance, you stand a much better chance of overcoming bias-centered investment practices that make many investors lose money. Before you buy your next investment, ask yourself, what's my decision based on? If you've made it this far, thanks so much for watching. Hope you learned something new. Please consider liking and subscribing and hitting that bell icon so you never miss out on new content. See you in the next one.